Let's connect with Dipan Mehta as well, who joins in on the show. Hi there, Dipan. Good morning. What's been your key takeaway from Hero Moto Corp's quarterly performance?
Yeah, good morning and thank you for having me on your show. I think the performance on the face of it is good, but the problem is the sustainability of the numbers going forward. And clearly, I think they have been able to increase their market share. The new products which they have launched are highly successful, and they are actually that's helping them gain the market share. The raw material costs have been pretty, I would say, on the lower side. They have been stable. Therefore, operating profit margins have gone up and also operating leverage has come into play. But look, we are seeing an overall slowdown in consumer spending, and there is stress when it comes to big ticket items, as we have seen in a lot of other companies. So sustainability is a bit of an issue. And also, I think monthly sales numbers also have come off for Hero Motocorp. There is though one silver, ray of hope, and that being the monsoons. As you all know, it's 7% above normal, and that generally increases agricultural income. And Hero Motocorp has a great exposure to the rural and the agricultural sector, so you could see some bump up in demand over there. But urban consumption is under stress, and that may affect or balance out whatever gains they have on the rural markets.
Okay, yes, the rainfall has definitely been better than expectation, and that's something that might have an impact. I also wanted to talk about some of these stocks which are at life highs or 52-week highs. And very interestingly, quite a few candidates are coming in from the pharma sector. I mean, overnight as well, the numbers from Marksons, etc. weren't bad at all. Are you now looking at even the second tier, third tier pharma companies, which were those underperformers in the last cycle?
Yeah, absolutely. I think you could strike gold over there. Companies, as you mentioned, and also there are others on our list like Kaplan Point, Ipca Laboratories, Bliss GVS. I thought even Natco Pharma was very impressive. Alembic could make a comeback. So there are lots and lots of pharma companies. They all have slightly differentiated business models. They focus on different markets and different molecules. And there's considerable scope over there. For many quarters. They have been under stress because of competitive pressures globally, and especially in the US generic market. And also US FDA problems had led to supply constraints. But gradually, I think a lot of the factors have improved for pharma companies. And I'm very positive on the pharma sector. In fact, that is going to be the target sector in the event of a correction. And we like to be overweight pharma. I think structurally also some things have changed in the US generic market, where they're now able to get at least a fair price for whatever they're selling over there, the pharma industry.
In your take, Dipan, as to what your outlook has been on some of the recent listings that we saw yesterday, for example, I don't know if you track, but Brainbees, the parent of First Cry, had a pretty strong listing. There was Unicommerce. There's some latest brokerage notes coming in on Nykaa. So just sort of tying it in as to what your outlook is within the space and these recent listings.
First of all, I'm delighted that so many new companies with such unique business models are getting listed. And that just increases the choice for investors, and they can then invest in several different and I would say diverse investment themes, and not just the typical infrastructure consumer play, which we are used to, or exports for that matter. And truly, I think that these new age tech companies, they are going to be the future of India's capital markets, and investors have to figure out a way or a strategy to invest in them. For the time being, we are just studying these companies. In my experience in dealing with the first wave of such concept stocks which went public, the likes of say Nykaa or Zomato or Policy Bazaar, Paytm, one lesson which I have learned is not to buy them at listing or even a few weeks or months after that. Let 2-3 quarterly results come. Let us understand the commentary from the market. There usually are disappointments after the company gets listed when it comes to quarterly numbers, and stock prices do tend to correct. And then the management then kind of makes adjustments to start to show that when they can reach profitability. And that's the time when one can invest in these companies. So I'm just putting them on my watch list. I'm reading up a lot about them. They're on the public domain, so a lot of information is available, but I'm not investing in them. These companies have to be studied more carefully than the run-of-the-mill companies which are already listed, and they require a considerable amount of insight, which takes time to develop.
So with that logic, you would say that I'll avoid Ola? Is that what you're trying to indicate?
Yeah, absolutely, Nukunj. I think it's best to avoid Ola Electric. Let 2, 3 quarters play out. Doesn't matter if you are buying even 25, 30% more expensive, but the risk reward will favor you because the downsides would be capped. The real problem here is you buy Ola at these levels and then you have 2, 3 quarters which are very disappointing, and it does appear that the volumes are not picking up as per street expectations, and road to profitability is further delayed down the line. You could easily see a correction of 30, 40% in these stocks, as you have seen with Paytm and Nykaa and even Zomato for that matter. And then you get stuck with those holdings at that prices. So it's better to, I would normally not time a stock where, we have full conviction, but we don't have conviction as yet in these companies. So it's better to wait for a deeper correction. And more importantly, to understand the business model better. See, Nikunj, when these companies are in the private domain, a lot of the information is not known, how their accounting treatment, the major cost heads, how those costs are moving. All that is not really, available in the public domain easily. But now that they are publicly listed companies, you will have a lot more information, and that information is what is required to gain the confidence and the conviction to buy these companies.
Again, switch gears literally in this case from classic new to old, which is PSUs. There've been a subtle and a subtle correction has kicked in some of the PSUs. 10 to 15% is what they have reversed. So while your muscle memory will say PSUs are in a leadership spot, but 15-20% correction has kicked in a HAL and a BL and a BHAL. Have PSU or has the entire PSU basket peaked out, Dipan Mehta?
No, Nikunj, I don't think so. I think more interestingly, what is happening is that the P multiples of PSU companies are compressing. So what was trading at 60, 70 times now, because the earnings also have done well for a whole host of PSU companies, and I don't mean the oil marketing companies, you exclude them as a basket, but across the board, whether it is mining, engineering, defense, PSU banks, PSU NBFCs, even companies like NBFC, which are in the construction space, we have seen that the valuation multiples have compressed because earnings are done well and stock prices have come down a little bit. I expect this trend to continue for a few more weeks, if not months, and then you will get into a sweet spot where the price earnings to growth for the PSU companies is reasonable. By reasonable, I mean in the range of 1.5 to 2 times or so. Right now, I think they're in that 3 to 4 times type of a zone. And that perhaps is the entry point, because when you look at the way the order book position is shaping up for a lot of the PSU companies, it is pretty decent and they have multi-year visibility of earnings. But maybe a soft quarter, maybe a further correction in the price could provide a good entry point. And if I may just extend on the PSU bank side, the gap between the PSU banks and the private banks is steadily narrowing across the board, whether it is pre-provisioning profit growth rates, whether it is loan book, CASA ratio, even the P multiples, price to book are all converging. And therefore, I think at some point of time, you will find that PSU banks may be more attractive, or I would say, risk return favors them as compared to some of the high-flying private sector banks. But end of the day, there's just too much choice in banks and they're a bit overowned. So you need to be a bit cautious on that sector as a whole.
Nuresh, that same point on PSUs, a subtle correction has kicked in, at least that's my view.
Yeah, so a lot of these names have already moved up quite a bit, especially on the defense side. We've started seeing a lot of indications of topping out, whether it's a HAL or other names. Even the shipyard companies have started seeing a correction. Now, whether it gets into a deeper correction or gets into a consolidation mode is still a question mark. But a 15-20% correction in a lot of these names is normal. But for now, it looks like a consolidation wherein we may continue to be in a range and slowly drift lower, given that it's a sector which has lower institutional participation, etc. We don't expect a further uptick going on from here on. So the view is one needs to be careful of the whole PSU basket as such. On the defense and even railways side, railways has yet not seen a sharper correction, but even that could see a correction of 20% from the top. So for now, the only space in PSU which still looks interesting is oil and gas.
Oil and gas, very, very interesting, because ONGC yesterday hit a 52-week high. Dipan, I mean, there is merit in saying that this is one space, at least, if not if not ONGC and Oil India, at least HPCL, BPCL, they're cheap. The spirit of deregulation is completely intact. Government has not taken any political decisions. There's a complete pass-through when it comes to fuel retail pricing. Expansion has started. So is this one space where one would say there is value and there is scope of outperformance, HPCL, BPCL, maybe IOC?
No, Nikunj, I'll grant one thing that these are great trading stocks, and you could get 15, 20, 30% return in a few weeks if you get the timing right. But from a longer term perspective, I'm not so sure. End of the day, there's a great deal of volatility in their earnings despite a high degree of flexibility when it comes to pricing. The way the refining margins go up and down, I think it's one of the most volatile commodity indicator, I must say. And that does, kind of put investors in a flux. And if you look at even the 5, 10, 15, 20-year track record of oil PSUs, they've not delivered great returns. And mind you can compare these returns to other commodity companies like a steel company or a cement company, where even if you take 10, 15, 20-year returns, those have been quite impressive. You could add aluminum to the list. But when it comes to oil marketing companies, their long-term stock returns have been very disappointing. So that kind of, just makes us a bit cautious. But, things can change. Who knows? But as I said, I think so long as there's so much of earnings volatility, it's best to kind of stay away. There's though one exception, if I may mention, Nikunj, that is Gas Authority. And I thought they came with a very good set of numbers. And something is positive happening over there. Their transmission margins have gone up. They've got the trading in gas business pretty much, I think, in a good cycle, a better understanding. Style has done well and valuations are still reasonable. So I would, if you want to go for the oil PSU stocks, then I think Gas Authority is something which is quite interesting. One could look at it. And there's, of course, a growing demand for natural gas now that we are setting up more and more power plants. And overall gas consumption also is going to go up, so that will increase the transmission volumes for this company.
Dipan, I distinctly remember when we spoke last, you said that you were just taking it easy. You are just watching cricket, watching tennis and Olympics and not trading or not investing. Has that view changed?
No, not really. Actually, Nikunj just now preparing to go for a holiday as well. So just better to wait and watch, Nikunj. I know that, I have been calling for cautiousness and correction in the market. That has not happened, but we haven't seen a serious correction since COVID. I think June 22 was the last time we had a serious correction. It's been 30 months since then, I would say about 26, 27 months since then. The 200-day moving average has not been tested. It's just been complete blue sky with so much of liquidity coming to the markets. But I'm not comfortable buying at these valuations. And whatever cash we have in our portfolio is strategic in nature. Should there be a knee-jerk reaction to an adverse development or an overall broader correction time-wise or even price-wise, then in the past such corrections in bull markets, I never had any money to invest. And that's one lesson which I have learned, that I want to have some money to invest when there is a little bit of blood on the street. So I'm just, just keeping myself put. But I'm also glad that a lot of our investments have done exceptionally well. So even if you have cash in the portfolio, it's not that the overall portfolio, including cash, has underperformed the benchmarks or what our historical returns have been.
So, having said that, Dipan, when you're talking about opportunities, when there's blood on the street, what is it that you would look to pick up immediately, top three?
I think that, there have been interesting concept stocks which have got listed. You discussed one like this Zaggle Prepaid. Then there is RateGain Technologies, Ola Electric, to an extent. These are the companies which I think, have very different business models. And I have always, had good returns from such companies. They've turned out to be multi-baggers for me. For the record, I invested in Zomato around the IPO, and I've been, seeing fabulous returns over there. Companies even like Policy Bazaar, who knows, even a Paytm. So that's one section of the market where I'm keeping a close eye on, and where I feel that, interesting from a value perspective has emerged. Then we may invest over there for the long term. And long term, I mean 5 years, 10 years or so, those kind of ranges, because that's when you get 10, 15, 20 times the return. The second, I think, space which I again disclosed to you is pharma. Something interesting is happening over there, and you have the benefit of good corporate governance standards. You have the benefit of very aggressive managements, good quality balance sheets, low debt, M&A opportunities. Company like say Mankind Pharma, Dr. Reddy's, Kaplan Point, Ipca Labs, Ajanta Pharma. These are the interesting companies that we're looking at, to increase our exposure over there. As a disclosure, we may be investing or be invested in all these names, which I am speaking about. And then the PSUs. The PSUs, why? Because we are underweight PSUs, be it defense, be it railway stocks, or be it the engineering companies. So from a portfolio correction point of view, we will be looking at the PSUs in a correction.
Okay, Dipan, on that note, we'll let you go. Thanks so much for getting us all those ideas. So,
if you like this video, then like, share and subscribe to ET Now.